Therefore, the banks never have anything on their record sheets that shows you the volatility of housing because there's no capacity for it in the market, right? Like it's just it's so horribly inefficient housing that it like seems to protect itself from, these like market dips. Like I can't see why the top 200 Australian companies is considered a more unsafe investment than a townhouse in Leppington in Sydney. It just doesn't make sense. The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you and, if in doubt, speak to a licensed financial advisor.
Hey guys, welcome back to the Aussie Fire podcast. So today is essentially going to be part 2 on our using leverage to invest in shares little mini series that we're doing here. So you might have listened to episode 36 where we discussed using home equity to invest in shares and using leverage that way. And in there we also discussed the practicalities of using leverage and some different things to consider. So this time around, we're actually going to discuss the other options that you have because a lot of you are not homeowners. So obviously using equity from your house isn't going to work. It's not going to be applicable to you. And some of you probably don't want to use your home equity to invest in shares. So there is definitely some other ways that you can go about doing that. And so some of those ideas are actually geared ETFs or leveraged ETFs. So you might have seen them mentioned around the place, or you might have heard from them from someone you know. So there's a few of these actually available now in Australia. So we're going to discuss them in today's episode and how they work. And we'll also look at margin loans because I know some of you use those, and the product NAB Equity Builder specifically because that's somewhat popular in the FIRE community as another option for using debt to invest in shares. So we'll take a look at that and see how it stacks up, and then we'll kind of compare them all and do a little, pros and cons between them and when we might use each of the options and which seem the most appealing. So hopefully that sounds good.
Sounds good, Dave. Really looking forward to chatting about this today too, because it's been something on my mind a fair bit. Like all of these topics like margin loans and NAB Equity Builder have kind of been things I've heard about, never really dabbled in, but really been curious about. And then there's some other stuff like geared ETFs that I have dabbled in and would like to know more about because I feel like I dabbled in them without, really knowing what I was doing. But it'd be good to kind of unpack them one by one. Probably the one I'm most curious about personally that I'd love to talk about is margin loans. These are things that I've kind of heard about for years. I feel like I've only recently started to understand them. And even now today, sometimes I still think, is it a type of financial instrument that I'm not utilizing enough or at all, really? Should it be a little bit of my strategy? And I guess rather than ask you to explain margin loans, if I could just kind of ask if you would describe this explanation as accurate. I've always understood margin loans as this thing where like I give a company $100 and instead of them letting me buy $100 of a share or an ETF, they might go and buy more than that. Like I'm making a deposit on a house. Like they might say, for instance, go buy $500 of an ETF, just like a house. And I hope that goes up therefore overall much quicker because I now have, multiples of the amount that I put in. But just like a house, there's a chance that the value goes down. But unlike a house, the housing market's generally and banks are generally pretty chill with the idea of your house value going down or no one really knows what a house value is. So no one really panics, like someone's house during COVID could have crashed 40% in theory, but there's no good way in the market to know. So whereas margin loans, if what you're invested in crashes. I mean, how poor of a description is that, I guess?
No, I think it's fairly reasonable, man, because that's one you pointed out some of the key differences there between margin loan and your, having borrowings against your home being the perceived and practical stability of your home price, not transacting all the time and having that flashing price in your face every single day that the asset value and the debt is kind of one-to-one, kind of always matched up with each other all the time, like you do with a margin loan. So a margin loan where you're going to borrow against your share portfolio to expand that share portfolio further And typically you have an agreed, like a set limit, just like a property where the bank or the margin loan lender will say, we're happy for you to borrow up to maybe it's 60% or something, or 70% of your share portfolio, and have access to that debt to then invest in probably approved products. They might have a list of approved shares or approved funds that they let you invest in, and then you can expand your portfolio further from there. But even just looking at it, they're giving you, say, up to 60 or 70% leverage, and that's lower than what you would get against your house, for example, but it's still very, very high. Because if you think about it, as we record this in April, not too long ago, the market just went down, 10, 15% very, very quickly. And if you've been invested since COVID and periods like that, where there was a 30-day period where the market went down over 30%. So if you've got a 70% geared portfolio, you're going to be margin called there, because your equity is more or less going to be wiped out if you just leave it as is and have a 70% margin loan and your portfolio drops 30%. So yeah, definitely not. I definitely wouldn't leverage up that high with a margin loan. And in the current environment where we've got higher interest rates than we did a few years ago, the rates on margin loans are actually fairly expensive, to the point where I would say they're pretty unattractive and not really worth considering in almost every case. Because mortgage rates right now are roughly like 6% is probably the average mortgage rate that people are paying on their home. Whereas margin loans, I just had a look at a couple before we recorded this podcast from the likes of ComSec and a company called Leveraged, and the rates are between 8 and 9%. So they are very expensive, man. So I don't know if you'd be happy to pay that interest rate, but I certainly wouldn't be too happy to pay that. What do you reckon, mate? You want to leverage up?
8 or 9% for the loan. Yeah. It's hard, right? Because no, it sounds scary as hell. But it's like, if I think about it and I'm like, well, let's say you think that, the US stock market might grow at 8% per annum long term, and you can 3-4x that, aren't you going to get like 20-30% return on $1 invested or something before your interest? So you're still coming out pretty strong, aren't you? Like, just rough numbering it. But as far as I understand it, the interest is really high, sure. But as long as you're getting good leverage and you believe in it long term, then you end up winning, assuming that there's no crashes, which is kind of the scary part. I don't think we've talked about massively, right? Or have I got that kind of wrong there? It's the silver lining aspect of it.
Yeah, well, I think maybe we'll talk about the crashes aspect later when we talk about the geared ETFs, because I think we can talk about the mechanics of that and maybe even the behavioral side of that, because that's another big thing that impacts people. But on the returns and the interest cost, if you're expecting a long-term return of like 8 or 9% and your margin loan is going to cost you 8 or 9%, then at first glance, it looks like there's absolutely no juice there to squeeze. Like, the interest cost is going to equal your long-term return, so your profitability is zero by taking on additional leverage. But that's not technically true, because if you look at a somewhat extreme example where, let's say you took on a margin loan and you paid 8 or 9%, and let's say you pay 8%, and let's say you invest in something like IVV, which is essentially a US index fund, and it has a very low dividend yield of like 1% or so. So on paper, you're earning 1% in dividends, and then we got capital growth, which we'll get to in a minute. And so you've got you're having to foot the cash flow loss of like 7%, right? On that borrowed money, which is a massive amount to outlay each month. But then you get the tax deduction. So there's a negative gearing benefit that comes into play as well, which people will be very familiar with that with property. So it kind of reduces that 8% interest cost down to maybe something like 5%. Because you're going to get some tax refund there. So it's not quite as painful as it first seems because of the negative gearing benefit, but still not super duper attractive.
That makes sense. Like, in my initial thoughts, I think I forgot that the 8 to 9% is paid on, not on the principal. It's paid obviously on the size of the loan, which is like going to be 80% of the value of the loan. But I also forgot about the deductive element too, like the tax deduction part. And I guess in a lot of ways, I mean, a margin loan behaves very similar to an investment property, except the pros are that you're not having to deal with tenants and in a lot of cases, maybe pretty average property growth. You have a bit more choice or something. But the downsides are that the bank may come for you in a way that's far more likely than a home, right? So higher risk, higher return is the general impression I get with margin loans for those who can stomach the risk.
Yeah, I'd say that's a fair assertion there. So you're going to have to, I mean, if you are in a position where there's cash flow losses, obviously you're going to need to, just like with property, you're going to need to, by your best estimate, ensure that the capital growth that you expect is going to more than compensate for those cash flow losses even after your tax benefits. So that's probably going to be different in different environments, and it's also not something that's guaranteed. So you're essentially taking a guaranteed cash flow loss in the hopes that you make it up with capital growth. So that's, I suppose that's the trade-off that you have to make. But I'd be curious to know if you'd be willing to borrow against your portfolio. Maybe someone come along and said, hey, let me offer you a margin loan against your portfolio, Hayden, and you can access up to another $200,000 to expand your portfolio, but you have to pay the current margin loan rate, which is 8%. What would you say? Attractive or no?
I think for me, it would all come down to, it's a horrible answer, Dave, but it's like, where are we at in the long-term cycle of markets and their kind of like bubble-ish attitude? Because there's always a part of my head that always like looks at things like the US stock market or any stock markets and thinks like, well, damn, with, wages stagnating and most things stagnating, how has the stock market kept going up? Someone might have an answer for me, but it feels wrong. Sometimes it feels like, things are inflated right now. And that kind of like uneducated voice in my head that doesn't really understand it, that thinks like, what if I get a margin loan at the exact time that, we've just realized we're in a bubble? That's kind of the thing that haunts me. And like a lot of people might say that with property, but usually people's parents with property kind of drown it out because there are property bubbles, but there's that thing that's like, it's always going to keep going up. But again, that's just because no one's ever like, no one's had that fear.
There's a bigger support network.
Yeah, exactly. So that's kind of what scares me. Like the mathematics make sense. Like I'm like, wow, no, I mean, if you can at least cover a lot of the downside, if there is one of those margin calls or whatever, well, at least you get better long-term prospects. But I'm like, hell, I don't know. I mean, the S&P 500's gone up like 67% in 5 years. That's kind of terrifying. I don't know if that's right or not. And I'm not going to pretend to have an opinion on it. It's just enough to scare me as a conservative person with this sometimes.
Well, no, it brings up a good point, because even if someone would push back and say, well, then you're trying to time the market cycle and whatever, that part is true and that is difficult to do, obviously. But the pushback to that is, well, if you got a margin loan for $200,000 and you invested it all at once, you are taking a very big timing risk that we don't know what's going to happen next. As you kind of alluded to, we could be at a period where the markets are about to fall for an extended length of time, and then maybe, let's say, valuations revert to some lower level, so that even if companies continue doing okay, valuations kind of detract from where they are and then sit at a lower level for quite a while. That's very possible. No one really knows if that's going to happen or not, but that's very possible. So that's what can happen with a big kind of lump sum timing risk. So the alternative approach to that could be you borrow against your share portfolio with a margin loan, or you could do this with home equity, either way, and you just keep that money there for a time later when it becomes way more obvious that it's maybe a super attractive time to invest, when maybe markets fall 30 or 40% or something like that, which is a fairly rare scenario and gives you a much higher likelihood that it's a good time to invest a big lump sum like that, and lead to better than average returns.
I mean, it seems like people are keyed into that. Like during the early to mid-April US market dip, we had our busiest day on Pearler in history, highest volume of trades ever, ironically, and heavy on buys as well, which was... I
was going to say, were they sells or were they buys?
No, even to my shock, like it was an incredible number of people. To be honest, I don't know if people had money sitting around waiting for a crash, or if people naturally have cash flow buffers. Like let's say you're putting in $1,000 a month. Most people might have thousands of extra money. I'm not sure if people just brought it forward. They just said, screw it. Let's just put the next 6 months in. This seems cheap. I don't know. But anyway, that was just a fun fact for you on the side about timing. But that makes sense. I guess my last question on margin loans, if an irrational person, maybe I'm rational, irrational, who the hell knows, doesn't matter, like me, is scared to, do a margin loan because it's like the lucrative ETFs may be in a bubble. Could you dollar cost average into a margin loan? Does that even make any sense as like a viable strategy?
So I think how you would do it is the same way you would do a chunk of home equity, where you create the line of credit. Because we didn't say this, but with a margin loan, you're typically just paying interest on the loan and the facility stays kind of as is. You're not like paying back the debt as such. So you just have to pay the monthly interest. So in that case, you could dollar cost average, because you could create the line of credit, the margin loan, for X amount, and then you could just slowly kind of take what you need or what you want each month and drip feed into your portfolio. So I think that would be perfectly fine. So that's another way to get around the timing risk, I suppose, and maybe even the psychological risk of putting a lump sum in all at once.
Yeah, sure. All right, Dave. Well, that makes enough sense on margin loans for me for the moment. Still feels a little murky occasionally, but I think that does help a little bit. I think probably the most interesting thing on my mind for the last 6 or 7 years has been NAB Equity Builder. It's interesting to talk about a product so like described by the name of the company. It's not like a concept like, Equity Builder. It's like the NAB, National Australia Bank Equity Builder, which I think really speaks to the fact that NAB are kind of the only real big bank, or any bank that I know of at least, really, that kind of had this scheme and still have this scheme. And it piqued my interest a long time ago. And again, if you don't mind me kind of trying to describe it to you, and you can fact check me here because you're very smart, Dave. But as far as I understand it, NAB Equity Builder was basically NAB came along and said, hey, what if we create the same structure and process you have when you buy a home for yourself, except instead of buying a home to live in, you can buy ETFs or shares. There's a lot of nuance there, but is that a fair summary of it at a really high level?
Yeah, man, I think it is, because if you look at essentially the rules around how they've created it and the structure that it's kind of designed with, it's exactly built more or less like a home loan. So I definitely think that's what they had in mind when they created the product.
Yeah, so I looked at it years ago, actually. I think I was really, really interested in it because I felt really sad that I didn't have enough money to buy a home, and I wanted some leverage. And I went to the NAB Equity Builder website, like a big adult with my, 80 grand or whatever I had. And I was like so excited. And then I went to sign up, and they said on the website years ago, they were like, we're not taking new applications at the moment. And it broke my little heart, and I just kind of, put it out of my mind and didn't really think much of it again. But I got really interested in it because it seemed like there were certain ETFs and shares that they wouldn't give you great LVRs on. They'd want like 40% deposits or something. And then there were like really safe, broad-based things that they'd give you like 20% deposits and something else. And I just thought it looked really interesting. Though I have to say, one thing I didn't realize until I looked at it recently again was that they say it's like a home. It's like buy equity in the stock market or whatever instead of a home, but they sure don't price the interest rates like it's a home.
Yeah, that's the only thing, because it is a cool product, and I've looked at it several times in the past. And same thing as you, man. I've had some readers who reach out to me and say this is a really interesting kind of scheme or margin loan or product, let's say lending product, and they're using it to great effect and really enjoying it. But then I've also heard from other people, I tried to apply and it says that they're not taking any more people. So I'm not really sure why that is. Maybe they're wanting to limit their exposure, keep it controlled to a certain amount of customers. I'm not really sure why they did that, but I have seen that mentioned in several different places that they were not taking on, obviously not having the door open permanently to more and more customers. But on the interest rate, at the time that we're recording this, the interest rate is 7.75. So it's almost 2% higher than a mortgage rate. And although it is cheaper than a margin loan, which is good, it's not that much cheaper.
It's a lot cheaper than a personal loan too, right? though. I think that's the big, not to be too nice, but
I haven't looked at those for a while.
yeah, fair enough. Like if I just look up like Westpac personal loan, like I don't really know much about loans because I haven't taken them out.
So you're about to tell me that you can buy a car for a lower interest rate that you can buy a sensible share portfolio.
Yeah. I mean, obviously they're very different. But it looks like loans like 9 or 10%, something around that area or something like that for like unsecured loans. So, I mean, I guess my point is, the positive thing is at least someone's had a structure where they've identified that it's not a car. The downside is that, to your point, it's still 2% more than a home, which is a little bit upsetting as, people like you and I who are ETF investors, because I wouldn't exactly say that I feel safer with the equity in my home than I do with the equity in the ASX 200 or the S&P 500. Like I feel pretty secure in the American and Australian economy as much as I do in my apartment, my specific apartment of this specific construction in this specific part of Sydney often feels more exposed than the economy of, us and our big ally.
I'd love to know why it's priced at that level. Not necessarily NAB Equity Builder, but all of these products, because I'm thinking that it's more to do with the investor and the tendency of people to blow their accounts up doing a bunch of dumb shit. So I'm thinking that there would have to be a way to get, a lower risk, very tightly structured, very rules-based lending product where it's like you kind of tick all these boxes of like long-term diversified investors and you're able to get a lower rate. I still think that's a good innovation that has to come out at some point, surely.
I feel like the problem is we just know the price. We know the price of these ETFs every moment of every open hour in the market. And we just don't have that with housing. Like you think about it, it's like if you want to sell an ETF today, you can sell it for 30% less than what you bought it for last week if there's been a crash. If you try and sell a house today, you're going to put your house that you bought for 800 grand up on the market for maybe 700, and then no one's going to be interested, so it's not going to go to sale. And most people aren't just going to sell it for 550, so therefore the house was never priced low, and therefore the banks never have anything on their record sheets that shows you the volatility of housing because there's no capacity for it in the market, right? Like it's just it's so horribly inefficient housing that it like seems to protect itself from, these like market dips. Like, so I would just assume it's that. Like I think about Perla and our business, and I'm no expert. Anyone listening, don't for a second overestimate my capabilities, but it's like NAB would have to do the modeling and be like, well, damn, if a customer's given us 20% of VAS and there's a market crash of 30%, we're in the red. It doesn't matter that, historically it's never stayed at 30%. It doesn't matter about any of that. Like they'd have models on this that would deal with the real value of it based on real historical data. And I think that's kind of the efficiency of the listed equity market is kind of its own worst enemy there, would be my guess, because I can't see why the top 200 Australian companies is considered a more unsafe investment than a townhouse in Leppington in Sydney. It just doesn't make sense.
Yeah, so the promise with the NAB Equity Builder is that there is absolutely no margin calls. And I'd like to know if they actually honor that when there is maybe a sizable downturn. I'm sure this was around before COVID, if they honored that during COVID and people were able to simply just keep making their normal principal and interest repayments, because we didn't mention that, but that is a key component of the NAB Equity Builder, is that you pay principal and interest repayments over a period of, I think it's between 3 and 10 years. So it'll be depending on how long you would like to borrow for and maybe the amount that you're borrowing as well. But you'll basically put in a deposit at the start, like a home, 20%, 30%, 40%, something like that, and borrow the rest and get that bigger portfolio and then pay it off over a period of 3 to 10 years. So I'd love to know if anyone's experienced with using NAB Equity Builder during a downturn. I would love to know if your repayments stayed exactly the same, and if there was a point at all where you ended up in a very highly leveraged position, like 80%, 90% or more, and if NAB contacted you at all during that period to either, ask to change your repayments or anything like that. That would be good to know. So if anyone's in that position or was in that position, definitely reach out and let us know, because that would be very interesting. But we kind of touched on it earlier that NAB is the only one who has this product I mean, full credit to NAB for creating it, but that also, in my mind, creates a little bit of a dilemma where NAB has complete control over not only your ability to use the product, but the rules around what you can invest in, your leverage level, the price of the interest rate and things like that, because there's no competition for this product. So that's the only thing that kind of concerns me, even though I do like it overall.
It's a pretty cool idea. I imagine that the interest rate's deductible too, obviously, right?
Yeah, 100%. Yeah.
Yeah, so it's pretty incredible in a way when you think about it. Like, let's imagine you're a high income earner in a major city or something. You can effectively 5x your equity portfolio at a effective 4% interest rate after tax. That's pretty cool if you really believe in these stable ETFs, right?
It is. Yeah, I mean, it's an interesting proposition. Would you actually use, I mean, you tried to, Hayden, would you use NAB Equity Builder if you could get access to it now, assuming you were...
Honestly, even talking about it now, I was so upset. I wasn't ready to get declined on the first page. And I just thought it was so cool. I discovered it and I was like, oh, this is the coolest thing I've ever seen. And then they were like, go away. And I was like, no, I mean, just talking about it makes me think I might go and poke at it a little bit next week or something. I don't know what they have minimums in there, but it wouldn't be a bad idea if they don't have minimums to put a small amount of money into. I mean, I'm a big fan if you can afford to put a small amount of money into something that's not radically dangerous, then it's a pretty cool thing. Yeah, it's interesting. Sorry for my kind of contemplative pausing there.
No, that's fine. I mean, it might also depend if there's any sort of credit applications that you're planning to make in the future with regards to like a home loan or anything, because this is a structured loan that might affect that.
This will be the home, right? That's how it's set up to be structured. I hope I don't get declined again. That would suck. That'd be a real kick in the teeth. Like I waited 7 years. No, it's an interesting product though, because unlike the margin loans, and we didn't really unpack the margin call aspect massively, but NAB will not hunt you down or try and sell out your stocks as far as we understand if it goes down. And it's a much more secure product than the margin loan aspect. If you don't mind me asking, Dave, because, okay, so margin loans, you said the interest rates are like 8 or 9%. And NAB Equity Builder, less than that. But NAB Equity Builder also doesn't have a risk of margin calls. As I understand it, is the main functional, because at a face value, you might think, well, why wouldn't I get the thing that doesn't have margin calls that has a lower interest rate? As far as I understand it, NAB have much more kind of specific rules, like for someone who, like margin loans out there, be tons of products that offer them. There'd be a lot more kind of flexibility of what you can and can't do with them. And importantly, as you said, they don't expect the principal repayment, margin loans. So basically, like for the same size loan, even though your interest rate might be lower with NAB Equity Builder, your repayments will be higher because they want you to contribute towards owning that amount that they've loaned out to you over time. Whereas with the margin loan, they're like happy to just carry that mortgage with them forever, so to speak.
Yeah, the repayments will be quite a bit higher. So if you think about a situation where you are borrowing, let's say it's $100,000, maybe you're putting in $30,000 or something like that. You'll have to pay that back over a period of 5 or 10 years, which means you're having to pay back either $20,000 per year in principal or $10,000 per year in principal, in addition to paying the 7.75% interest on the loan. So it looks very, very different in terms of cash flow than a margin loan does. So I suppose you can think about it like prepaying or pre-buying a big chunk of shares, and then you're basically forced to use all your cash flow. Well, maybe not all your cash flow, but use a huge chunk of your cash flow to then pay back the loan for pre-buying those shares. So in a similar way that a margin loan can be used, a NAB Equity Builder loan is probably best used for those periods where you want to buy a large chunk of shares. And obviously you might be taking a timing risk if you do that. And then you're happy to then just have the large ongoing cash flow commitment of then paying back that big loan over a period of 5 or 10 years or whatever it is. So it looks very different in terms of monthly outlays. But on the plus side, you've brought forward a massive amount of share purchases. So that's the benefit of doing that and getting the returns from a bigger asset base sooner.
Very interesting. So, I mean, I'd heard about margin loans for a long time. I'd heard about NAB Equity Builder as well. And then I don't know when it was, but I feel like a couple of years after that, the first time I remember someone talking about something. It was this little voice, don't know who it was from, where they were like, oh, there's these new, it's like a margin loan or a NAB Equity Builder, but it's inside an ETF, you know? And then I started hearing these words like internally leveraged, internally geared ETFs, leveraged ETFs. And I remember hearing about it and I was so confused the first time. And this is kind of where that term geared ETFs comes from. This idea that you could just buy an ETF like you buy a unit of VAS. You could buy a unit of geared VAS, they might call it. And then that would somehow be like NAB Equity Builder or be like a margin loan without any of the complexities, and there's no margin. And I don't know about you, but I remember hearing that the first time and just being like, I get what you're trying to say. I have no idea how that makes sense. And I did what any, you know, self-respecting idiot does. I went and bought $1,000 of it, just to be like, you know, that'll force me to understand it. And it often does. But to be honest with you, I actually didn't for a long time. I got the idea that, okay, I buy this geared version of the ASX 200. If market goes up, ETF go up more. If market go down, ETF go down more. Standard leverage things. And I mean, not to jump to the end here, but I sold it out. I sold out of it after owning it for 4 years just last week. And I kind of, at the end of it, genuinely had a feeling a bit of like, there didn't seem to be the crazy roller coaster I was expecting for it. And it made me read up on geared ETFs as well as in preparation for this conversation. And I'm not even going to try and explain it because I still find them a little bit confusing. And I'd actually just love it if you could just slap this one out. It's like, what is a geared ETF? Dave Gow.
Yeah, they are not the simplest vehicles to understand, I suppose. So the way I think of it is the most common ones that we have in Australia, and we'll talk about some examples in a minute, but they're basically like broad, diversified funds, essentially index funds. And then the fund manager will essentially add leverage by either using borrowed money or by using derivatives to kind of magnify the exposure. So they'll take like $1 of assets and then they'll use derivatives or borrowed money, and then you end up with $2 of assets in the portfolio as exposure when there's only $1 of equity in the portfolio essentially. So like you said, the good goal is to get magnified returns to the upside, but obviously you have to put up with magnified returns to the downside. So
it sounds like they do the margin loaning for you, for everyone in the fund.
Yeah, exactly. So the cool part is, I guess, you don't have to do any of these like credit applications and applying for a loan. You don't have to manage the debt yourself. There's no personal risk of having to like manage the repayments and all that. The fund manager is essentially taking care of all that in the background, managing that fund and managing the debt exposure inside the ETF. So you don't really have to do anything as such. So that is actually pretty cool when you think about it in terms of passive investing. It's right along the lines of what we speak about a lot on this podcast and in general in the FIRE community. So yeah, it is very passive. And I suppose that the thing is though, you're paying higher fees because you're having to pay the manager to essentially control that debt level all the time, control that exposure. So that kind of leads into how they manage these ETFs. So they'll try and essentially keep everything within an allowed gearing band, let's say, or a leverage band where they have a comfort level of the amount of leverage that they're happy to have the fund ride with. Maybe it's like 50%, between 50% and 65%, let's say. And as long as the fund is kind of within that level of gearing, then everything's fine. And if it goes above or below that, then they'll maybe have to sell down to actually reduce the gearing and get things back in line. So that's kind of how they manage it on an ongoing basis for a higher fee.
Interesting. Certainly not straightforward, is it?
It is in theory, but then once you unpack it and the mechanics of it, it's not super straightforward. But yeah, I mean, that's for people that's on a higher pay packet than us to figure out, mate. So there is, I suppose that brings up something important, that there is some trust built in with the fund manager. You trust them to be managing this debt sensibly, and you trust them to be managing the ETF and running things exactly the way it says on the wrapper and exactly the way it says on the fund page, and how you hope them to be running things. And so I suppose not only are the returns and losses magnified, but your level of trust in them needs to be magnified as well alongside it.
So if I could, let me do my best explanation and tell me again how it goes. But with a margin loan, you give $100, they buy $300 of VAS, say, and that VAS goes up and down compared to what you put in much faster than just investing 100. With a geared ETF, I give them $100. I buy $100 worth of that ETF, and they might behind the scenes say buy $200, of the actual, some kind of equivalent that they want to. If that $200 drops down to $150, in a margin loan case, they just kind of watch that and think, okay, that's fine, but let's keep an eye on it. Let's make sure it doesn't get too low, because if it gets much lower, we're going to need more money because this is risky. With a geared ETF, if it goes from say 200 to 150, internally the ETF will do some things like buy or sell. I'm not across the details, but they'll do that, and that's how they protect you, because they basically will sell down the asset so that then tomorrow, say if it goes down again, you've got less and less of that ETF to kind of crash. And it's just if the market was going down. So it's a very, very different mechanism. And it's really about the fact that every day they're doing movements inside this magical fund to kind of protect you from it. So there's never a margin call, and it can never go below zero. And there's no big interest rate. But the downside of that is that all that poking and touching can lead to some pretty weird results, as I think you've talked about before.
Yeah, that's a pretty good explainer, I would say. It is. I was surprised to find this out. But yeah, essentially these ETFs tend to be, the gearing tends to be reset or kind of recalibrated on like a daily basis. So there'll often be some, extra buying or selling happening and extra tweaking of the gearing to make sure that everything is staying exactly in line. So what tends to happen is that because of all the extra tweaking that they have to do, what tends to happen is that they end up missing a little bit of the gains on the upside, and then kind of also locking in a little bit of extra losses on the downside, just as a kind of inevitable consequence of the way that things have to be managed. And so there's a name for this after I looked into it and was trying to figure out how these things work. There's a name for it, and it's sometimes called volatility drag, and it's sometimes called time decay. And essentially it's just a little bit of a drag on your long-term return. So I think some people will assume that, well, if my geared ETF has 2 times the leverage of the, Aussie index fund, then I should get something like 2 times the return of the Aussie index fund, maybe minus the interest costs or something like that. But it's not going to be anywhere near as good as that, unfortunately, because of the way these things are managed and then the interest costs as well. So the outperformance, unfortunately, isn't quite as good as people would hope it's going to be, I think, especially when you consider the levels of volatility that you have to put up with to get the surplus or to get the extra returns that you are getting or hope to get from a geared ETF.
That's really interesting. So that kind of security and simplicity comes at a cost. I thought it was interesting when we were chatting earlier about how, like you said, sometimes the geared ETFs will put out like 10% distributions as well, which I thought was really interesting because, like, obviously if they're doing lots of buys and sells within the ETF, they have to push that. A lot of customers at Pearler, I find, often mistake dividends from ETFs as thinking they're actually all dividends, like company profits coming to them. Whereas, like, and I've been through that too, right? Much of that is actually just the ETF buying and selling stocks, and making a gain on it and passing that on to you, and you pay tax on it. That's not a bad thing. But I have also started to learn, Dave, the general lesson that if there's an ETF that's paying you a lot of distributions, usually that's coming at the expense of the growth of the stock. Now, it's a very hard and fast rule and certainly not universal by any stretch. But yeah, but then also at least you're getting 10%. That sounds amazing. I mean, you're not saying that's all the time, but like, couldn't you argue that a geared ETF in a weird kind of way is making up for its odd performance by pumping out all these strange tax distributions?
No, I wouldn't.
Not enough history to know.
I wouldn't say that necessarily, because if you're just crystallizing a bunch of gains and paying that out every year, that's a terrible way to invest. That's typically why, like, even if you outperform the market by buying and selling, you're probably going to underperform the market after tax. So you want to be really careful how much transacting you're doing to even outperform, because you've got to pay taxes, and then you're probably worse off than if you just did nothing and had a low turnover portfolio that just held everything and did nothing. So I definitely wouldn't say that. So essentially, people on high tax brackets would probably want to be careful, because sometimes these funds will pay out like weird erratic sort of distributions where it's very high. So you're going to be potentially losing chunks randomly to tax that you might not expect. But if we just go to some examples here, mate, so we can get some ideas on the fees and the performance historically, because I think people might be interested in how these things have performed, because we've actually had a couple of options now in Australia that have been around for roughly 10 years, which is a fairly decent length of time to be able to judge them and be able to potentially have a look at how they might perform in the future and what you might be able to expect if you put one of these things in your portfolio. So the oldest one I could find is, I think, Hayden, this is the one that you were telling me you owned just before the show, and that is called GEAR, GEAR, and it's essentially the oldest geared ETF in Australia, and it tracks I think it's ASX 200, and it's operated as essentially 2 times leverage. So the LVR is something like 50% to 60%. I think they manage it within that band. And so essentially, if you buy $1,000 of this ETF, you'll get exposure, let's say, to $2,000 of the ASX. And the fee on that one is 0.78% per annum. That's the management fee. So that's a fair bit higher, especially, let's say, A200, which is very, very, very low fee. So it is fair, because you are paying for a fairly additional service than what you would be just with a regular index fund. And if we look at the performance, so this thing came out in 2014, and so it's now been 11 years. And the total performance over that time has been 9.2% per annum. And that is versus the index of 7.6% per annum. And so that is actually after this recent market fall that we've had. So essentially 1.5% outperformance per annum over a 10-year period. So not massive, especially when you consider it's like 2 times leverage. Not massive outperformance, but 1.5% per annum is not too bad, mate. Nothing to scoff at.
No, for sure. It seems like it's just another mechanism. The interesting thing about this mechanism is that you compare it to margin loans and stuff and everything else. You really it's all just the different weird ways the world will work, in what order and markets move will just have different results with these different kinds of things. And I feel like that's my kind of takeaway from looking at it too. It's like it can perform well just like the other ones. And in some ways, it's probably really helped that the market hasn't dropped. And I don't understand it significantly, I was going to say, but I don't understand it enough to kind of know the nuance of when this is particularly good or particularly bad. I think from my perspective, and I should probably clarify, I owned gear for a while, and I wouldn't say it was a bad idea. I just felt like after 5 years of it, I didn't feel like I understood it well enough that I wanted to keep holding it. And it wasn't outperforming VAS dramatically. So I was just I just prefer to invest straight in the companies, sleep at night a little easier rather than something I don't quite understand. But it's really interesting about the outperformance as well. Even amidst the stuff we mentioned, it still obviously does a pretty good job, or has done, I should say, is the correct expression.
Yes. Have you, when it was in your portfolio, did you look at it on a regular basis to the point where you could see the difference between the volatility of that one and your regular Aussie index fund, let's say?
Yeah, a couple times, but I didn't get too worried. Look, I think when I bought it, I thought it was just a really simple margin loan-like thing. And then once people like you started saying all this stuff about rebalance daily and whatever else, I started to be like, oh, I feel like I now don't understand where my money is. Some people might have had this experience with crypto, at least I did, where I put money in crypto because someone was like, it's like a currency. And then as I learned more about it, I was like, I realized as I'm learning more, I don't understand it very well. And now I feel like I put my money somewhere I don't really understand. And it's like a little funny. But yeah, I did watch it, Dave, and it did go up and down. And I think I watched it go down at one point and up at another point. And yeah, I was just like, this is like VAS on steroids, really, was my impression.
Did you own it during COVID?
I don't think so. Or I did own a little bit, but not enough at the time. I think I bought a couple grand of it in like 2022 or something.
Okay.
Which is another problem because I got really lucky. I've been lucky and unlucky over the last 7 years. But one thing I did get lucky was I bought like a whole bunch of stuff right after the recession kind of pulled the market down a bit. So it's really hard to tell because most of what I had just had kind of been green for a long time. I don't know if anyone else has this experience, but if you're not looking at your portfolio in detail, if everything's green, if it's more than when you bought it, you don't spend a lot of time kind of staring at the exact number. You just log in and you're like, oh, green. Okay, good.
Green is good, yeah.
Okay. Check again next week, yeah.
Yeah, no, that's fair enough. I mean, I think people would potentially listen to that outperformance measure of 1.5% per annum. They're like, oh, well, I'll sign up for that for the next 30 years. That sounds great because that's going to have a massive compounding effect over that time period. But there's also the downsides that we mentioned before. And I wrote an article about leveraged ETFs. I think it was last year or potentially even the year before. And I was having a look at the performance. And even though there is outperformance over the long run, when you look at these things during downturns, they are absolutely atrocious, like absolutely painful. So this one in particular, Gear, during COVID, when the ASX dropped 37% in that 1 month period, Gear actually dropped by about 66% or 67%. And that's in a period of 1 month. So I can't actually imagine too many people being able to sit through that and, you know, kind of grinning and bearing it and being very happy with that kind of situation. I think many people would either give up on it and stop investing in it, or they would frankly sell out of it once it passed 50%, especially with the uncertainty that was around at that time. So I can imagine, man, if the market actually fell further than it did during COVID, like a GFC scenario where it fell something like 50%, I reckon Gear would be down something like 85% or potentially even 90% just based on how it performed during COVID. So I don't know anyone who could probably sit through that, to be honest.
One thing I'd be really interested in, two things I have to say on this, Dave. One is like, I have a maths background and stuff like this, so I kind of get it a little bit, but I'd need to sit down with it for hours and hours. It's like, if VAS goes down by 20% and then VAS goes back up by 20%, say it goes down by 20% over a week and then it goes back up the next week. If you own something like a margin loan or NAB Equity Builder, your portfolio is going to be back where it started because it's just the asset, right? With geared ETFs, like say with Gear, if they're doing rebalancing daily, I have a suspicion that wouldn't be the case because if they're doing all and I imagine it probably doesn't go well in the favor of coming back up, I would guess.
No, I think you're 100% right. I think they even say that on the product page and I've seen examples of this too, when it goes through a period like you just said, when the market goes, say, down 20% and then up back to where it was before, your return won't be 0%. It'll be negative because not only is there interest cost to pay, but because of all the constant rebalancing, you end up having a slightly worse. This kind of volatility issue kind of comes into play here and you end up with a worse result than you would have, otherwise.
Because my peanut brain was sitting here before thinking, oh, well, at least there's no interest in the geared ETF because they don't charge you. But then I'm like, they do charge you. It just comes through in the performance.
Yeah.
Like there is interest because they take out a loan. It's there. Like you just don't see it because it gets absorbed. Just like the management fee. You never really feel it. And the question I was going to really get to ask you, Dave, was like, so like in theory, let's say you believe in VAS, you believe in the Australian economy over the long term. You're going to hold it for 20 years. You don't need the money, 100%. It's a trust fund. I don't know what trust funds are or how they work. But like, why would you not always buy Gear instead of VAS? What's the scenario? Like if it's just leveraged and managed, what's the scenario where that person who holds it for 20 years and manages to like sell it after 20 years in a mid market, no bull runs, no crashes. What's the scenario where that person is screwed over by it?
I can only imagine a scenario where the returns are either highly volatile plus also being very mediocre returns over a long period of time. So where the ETF itself is kind of diluting itself with all the volatility and rebalancing, and then also the market itself doesn't perform great over that 10, 20 year period. And to be fair, like it might be fine, but there could be cases where it doesn't actually outperform the index fund because of the issues that we described. So if you look back, it really doesn't. I mean, if people want to go and look at the charts of these products on the BetaShares website, you'll actually be able to see that during downturns, almost all of the outperformance essentially disappears during a downturn because it is so magnified. The drop is so kind of atrocious that all the outperformance that you've enjoyed for the past 5, 6, 7, 8 years just basically disappears. And so you're left to either commit to your strategy and sit through it and keep investing and then, wait for the good market again. But it definitely would not be easy at all. I mean, there is also, we've only spoken about the Aussie one, but there is also a US one called GGUS, and that one has performed better than the Aussie one, not just in terms of total performance, but in terms of how much it's actually beaten its index over that time. So it's actually beaten the index since 2015 by about 4% per annum. But that's during a period where the US has performed far better than its historical return. So that there's that to consider as well. During a normal kind of 10-year period, the outperformance would not be that high, I wouldn't think. But it's probably worth talking about the newer products, mate, that have come out in the last year or so from BetaShares, because they're quite interesting too. And they do kind of seem a little bit better than these other ETFs that we've discussed.
Tell me about them.
All right. So essentially, BetaShares has recognized the issues of the volatility drag and having to rebalance constantly. And so instead of using derivatives for their exposure, they're using direct borrowing. So they're using essentially cash borrowings. And so I didn't mention this before, but the reason why these things are also useful is that they're able to get cheaper interest rates than we can access because they're classed as an institutional or a wholesale borrower. So they're borrowing way, way, way more than we could. So they also get a lower interest rate. So that's obviously worth mentioning as well. But they've created a few new funds. And so there's 3 that we'll just quickly run through. And they are essentially the same sort of idea geared funds where you get magnified exposure to these indexes, but they're a little bit more conservative than the other ones, and also the cost is cheaper. The management fees are much lower. So there's one that is a magnified exposure of A200, and that one is called G200. I'm guessing G is for gearing. And the management fee on that one is 0.35%, which is actually not bad, really, when you think about it. It's also far cheaper than gear, actually, which was over double that cost, I think. And these are running at like a 30 to 40% leverage, I believe. Whereas gear and the other ones were more like 50, 65, something like that. So it is much more conservative as well. There's also one for NASDAQ, so GNDQ, and the fee on that one is 0.5%, which is basically exactly the same as the NASDAQ ETF. So that's actually pretty reasonable. They're not really charging you more, which is kind of interesting. And then there's one that copies DHHF, and it's called GHHF. That one the cost is 0.35%. But that's not too bad, man. These things are quite interesting. It's still too early to see how they perform, but just looking at them on like a daily basis, I've got them on a little watch list I've been having a look at out of curiosity, and the performance is definitely magnified. So that's very interesting. The NASDAQ one went, I think it was either up or down 10% the other day. So that was quite interesting. So yeah, I'm keeping an eye on these things. They are very interesting products. Have you had a chance to look at these yet, mate?
I've seen them around, but no, I mean, I didn't quite understand it. I have to say your explanation of like the old geared ETFs use like weird derivatives markets, whereas these like new wealth builder products just use like, I mean, I'm sure like, NAB's a bank, so it doesn't borrow money, but like when you invest money in NAB Equity Builder, it obviously in theory gets a loan for your money, right? So that's a simple concept for people to understand. I think that is quite interesting.
The NAB employee types the numbers into a screen and then clicks the button and then push, the money is created.
Yeah, money appears out of nowhere. I think it's also interesting that they've lowered the gearedness a bit, which I imagine is because like they've probably done modeling on like what is the worst case. I mean, I think most people will find it pretty reasonable to assume that a lot of these ETFs will not crash by more than 50%.
In most scenarios, yeah.
Yeah, or like never crash 70%, for instance, or something like that. And I imagine they've probably done some modeling and realized, I'm just guessing here, but like if they turn the gear ratio down a little bit, then there'll be a little less Armageddon types of situations. But it is very interesting. I mean, I do wonder, be interesting to see what the interest rates are. My first thought was like, I wonder if the interest rates are like deductible or how that handles itself. But then I realized it's probably irrelevant because they're probably not deductible, but they're probably getting interest rates I can't comprehend. So it probably doesn't really matter. I mean, when I say that, I don't mean like 1%, but
I think I read somewhere that it was like the RBA cash rate plus X percentage, maybe is it plus 3% or plus 2% or something like that? Don't quote me because I can't remember exactly what the figure was, but it was, RBA cash rate plus something. So it'll be tied to the cash rate.
Yeah, I mean, I'd be interested in that. Like if it was still RBA cash rate plus 2 or 3% and that's not deductible, then it would be really interesting to kind of compare that to, say, a NAB Equity Builder. I mean, they're very different products, but like, you know, for a lot of people out there, if interest is clearly deductible, that has a big impact on things as well.
Yeah, that's the, I suppose that's one of the downsides with the geared ETF option. I mean, the interest that the ETF pays or that the fund pays is deductible against the income that the fund earns. So in that way, it's deductible and kind of reduces tax on distributions, let's say.
And when you say income, you're talking about like any dividends from the companies or any capital gains from the sales of a rebalance.
In the portfolio, yeah. But then if there's a difference there or a kind of a cash flow loss there, the benefit does not translate or transfer onto you, unfortunately. So that's how I understand it anyway.
Very interesting products though. I mean, you know, leverage as a concept is so cool, isn't it, Dave? Trying to get more out of what you have. So I don't know. I think it's really cool. I'm going to take another closer look at these as well. It's a shame they don't have just a simple leveraged S&P 500 wealth builder product. That's where my mind's been a lot recently. So
you want just the S&P by itself?
Yeah, I've really soured on the NASDAQ 100. I don't know why. That's not financial advice to people.
Is it too tech heavy for you?
I just don't understand tech companies. I can see a future where like they run the world already. Maybe they're going to keep running the world. I can see how that would happen. I could see how they all just keep getting bigger. And I could see a world where we look back in 20 years and we're like, hey, do you remember that period where like Trump got inaugurated and it was basically the 5 tech companies hanging out behind him, and it was like some weird oligarchy type. I don't know. So it's just like it's a very specific bet for my liking nowadays.
Well, what about GHHF? Because that has a US fund inside it, and it's a total market US fund. It's not the NASDAQ. But then you also got the Aussie portion, and then there's the Europe portion and the emerging markets portion, and you can't split them out. It's just an all-in-one geared portfolio, which is actually a very simple, very cool option, I think. But I definitely want to see how it interacts and how it goes over the first couple of years. But I'm definitely keeping my eye on that one, man. That's pretty interesting, I think.
DHHF is cool. I do like it. It's funny, Dave. I actually learned from you in this regard. I used to start, when I was recycling, I started buying DHHF. I was like, I'm going to keep it really simple. And then shortly after I was recycling my loan, I was talking to you and you were like, yeah, I like VAS VGS because I can kind of control the relativity between them. And then I was like, that's a good point. So then I kind of stopped putting money in that and DHHF. And it has been kind of nice. Like, not that a normal person needs to think about that, but I do have to say, like, after months and months of investing, occasionally I sit there and think, do I really think my money should be in like 2/3 the world, 1/3 Australia? And then I'm like, that seems a bit wrong for how my completely irrational and educated brain thinks at the moment. And then I might want to, put a little bit more of my money in one bucket for a while. So I've they're great, amazing products. They're super cheap and ridiculously diversified. But yeah, I don't buy a lot of it anymore.
It's really interesting because that ability to tweak and that control that you have is a benefit, no doubt, but it can also be a downside because you're kind of tweaking.
Yeah, because I don't know what I'm doing.
Because you inevitably tinker and you inevitably tweak things, and it's most of the time unnecessary when you could have potentially just been far better off and had far less headache and far less mental strain by investing in the all-in-one product. Not that I do that personally, but I can see the benefit of it because when you only have one thing to look at, I suppose you're going to log into your portfolio and be like, oh, well, it's doing what it's doing. And you're not going to second guess the different parts that are inside it because it is what it is. Otherwise, you're going to have to kind of recreate your portfolio from the ground up.
For sure. It's like, it's a trade-off, right? Like, at the moment, I feel like the US market's undervalued compared to the Australian market just because it's gotten a big hit. And I enjoy that I can go put money into my US ETF as opposed to like my DHHF where it's everything. But to your point, that's more time, that's more energy, that's more thinking. There's a chance you do that wrong. And then you're like, oh my God, I now participated in my own destruction. So yeah, it's for sure. It's a trade-off, definitely.
So if you were, let's say you were starting your journey again now, and let's say you were renting with no prospect of buying a home anytime soon, do you think you would go with these kind of geared options, whether it's margin loans or whether it's, NAB Equity Builder or whether it's just geared ETFs? Do you think you would go after some sort of gearing in that way? And if so, do you have any preference for any of these options on how you would invest in that kind of a scenario? Curious to know. It's
such a great question. Yes and no, like many times over.
That's a terrible answer.
It is a terrible answer. The answer's it's not even really if I started over, would I use them? Because it's kind of like, should I use them now is the same question to me in a way, right? Like if I should use it now, I should have thought of it 7 years ago. Generally, circumstances change. I think so. I wanted to use NAB Equity Builder. One thing that I'm becoming more aware of now that I have an apartment is credit score. That's something I didn't quite think about till you brought it up. Not credit score, sorry, total credit capacity.
Borrowing power?
You call it. Borrowing power. That's the word that smart people use. And it's like, yeah, okay, well, NAB Equity Builder, if I did want to turn around in a few years and buy a home, I might be forced to sell the apartment in order to have the borrowing power, because the bank might be like, oh, it's a shame you got that NAB Equity Builder. That wasn't looked pretty leveraged out there. That's probably the biggest thing on my mind. But I think they're great. Like if you believe in these, products like these ETFs for the long term, you believe they're going to stay strong. To me, something like a NAB Equity Builder, I want to say margin loans, but I'm still scared of them.
Yeah, they're a different.
They
kettle
seem
of fish,
interesting.
I think.
Yeah, they're like a real, like margin loans are for the real loosey-goosey uncle you have who's just living on the edge, is how my brain kind of, interprets it.
It's so interesting, man. It must have been during COVID when rates were basically at zero and even mortgage rates were like, what was it, 2% or something? There was dirt cheap margin loans in the US. I think they were like 1.5% or something like that. Like I would find that completely irresistible if you're able to kind of borrow against your share portfolio and borrow and pay 2% or something. That would be so good.
No, for sure. So I guess the short summary is, yeah, it's something I would genuinely consider now or look at a bit, even just a small portion of it, because the great thing about small stuff is you can figure out if you like it. The geared ETFs or these new wealth builder ETFs are pretty interesting too. I feel like sometimes the really abstractedness of them makes me feel like I'm complicating it a bit, and I probably would want to see them expand a bit. But this whole new one you've talked about today that I didn't know about, these new beta shares ones, they seem really interesting because I feel like I kind of get the concept of it. And to your point too, I'd probably just want to see how they perform a little bit and keep reading up on them. But yeah, it's all interesting. The general concept of leverage that I feel like is beat into most people is like, as long as you aren't forced to pull the money out when you don't want to, and in the case where a bank demands more money, for the case of margin loans, then leverage is a good thing, right? Like that's what most of our parents would say is like, if you can afford to buy a house and not be forced to sell it when the market's down, then it's a good investment, right? Like it's of a similar principle.
But they'd also say you're mad to do it for shares.
Yeah, exactly. Yeah. Got to be careful. Yeah, for sure. But the principle's there, right? Like leverage is as safe as you're financially secure, and how much you put yourself over the edge with it. So I would just apply those kinds of principles. But I think it's worth dabbling in at least, right? Like just to learn more for any of us.
Yeah, they're definitely interesting options. I do like the look of the wealth builder products that Beta Shares has just come out with. I don't believe there might be one other geared fund on offer in Australia. I don't think there's a whole slew of them though. So the options will probably expand over the next few years, just as the options with everything else has expanded, which is pretty cool. So it definitely gives people a new option and another way to invest for the long term in a magnified way to get that extra market exposure. And if I was starting to kind of switch the question back to me, I guess if I was renting and just starting, I would definitely consider some of these more aggressive options. I probably find the NAB Equity Builder more attractive than a margin loan, and I find these wealth builder ETFs more attractive than the original Gear and GGUS. I find those a little bit murky and also just too volatile, to be honest. Like, it's just going to be too stomach churning to see your portfolio go down 75, 80% in a crash. I don't think I could do that.
I think that's a great point. And I love the kind of focus on something like a NAB Equity Builder, because people have to remember, if you're listening and you haven't heard of these things before, NAB Equity Builder was built for long-term investors who just didn't want a piece of the housing market. Margin loans have not been a product that have been developed, matured for long-term investors. They were invented, as far as I understand it, for largely people trying to, do short-term gains and traders and things like this, right? Like, they didn't grow out of a sub-community of people being like, I want to buy an ETF for 30 years. So, you kind of got to think about that when you buy it. Like, it's not really for us in a sense. Like, it can be used for us, but it wasn't built in the image of, financial independence and long-term investing. And that just spooks me a bit too, as opposed to, something like NAB Equity Builder. And
that's why I'm going to keep pestering you until Perla builds something that's designed for that. Some sort of a low-cost margin.
That's all I want. NAB Equity Builder at the current mortgage rate. That would be, I could die a happy man if that was produced. But that's hard.
Another thing that's just worth mentioning here is we're talking about portfolio losses and stuff like that. And I mean, you can use home equity to invest in shares and you're going to have the same dollar losses, but because you don't match because you're not looking at your debt level and then looking at your portfolio on the same screen and in the same lens, you're not going to notice, or you're not going to feel that volatility as much because you've just bought regular shares with borrowed money. So you're only going to look at the volatility of your shares in your portfolio. But if you're looking at the same level of leverage, but through a margin loan account where you're seeing yourself get squeezed, where your equity is kind of shrinking there and the debt level is kind of creeping up, that's going to feel totally different. And the same for a geared ETF where it's magnified and you're getting, 30, 40, 50, 60% losses over a certain period. So even if the losses are the same, it's going to look and feel totally different. So it's just a different way of experiencing the same thing. So that's worth keeping in mind as well.
Yeah, for sure.
Because I suppose it's a little bit like the housing thing you mentioned before, mate, where you can't see the volatility of the house price, so you don't really think about it. It's probably going to be the same thing if you're using home equity to invest with.
Yeah, definitely. And it's definitely worth thinking, man, I wish it didn't affect the credit score or the borrowing power thing, because I feel like just even talking about it tonight makes me want to go rip all my money out of, and put it in that. But yeah, I want to check it out a little bit. I imagine too, there's rules around you can't just pull it out willy-nilly too, or there might be. Anyway, you can read about it. We can read about all the fine print.
I mean, if you had to summarize it, mate, who would you say that these options that we're speaking about today are best suited to, given the risks and the features that we've described?
People with low risk lives, like I think any kind of leverage, like you need to think of this money as locked away. I met people who invest money and then they're like, I need to pull it out for a renovation, or I need to pull it out to like cover this cost, or, my kids are going to school and I can't invest anymore. And they've done that within a year or two of, even myself, like there's probably a part of my head that knows that I still am undecided if I just want to live in this apartment forever peacefully, or if I want to try and buy a home in Sydney and forever be indebted to this horrible market till I'm old and decrepit, right? And it's like, if I was to be interested in buying a house in the next few years, we could hit a bear market right when I'm trying to buy a house. And if you're in a leveraged product, then that can be really bad. So I'd say it's all just about how likely are you to be compelled or forced to pull the funds out early? And if the answer is I'm not, then they're very interesting products. And if the answer is I am, then it's like, why would you add the stress to your life? Maybe would be my best short answer.
Yeah, no, that's well worth pointing out. It's always going to depend on the individual involved. But I think you want to be someone who, to your point, is able to not just invest once, but is able to consistently invest over a period of time because of the volatility involved with these products, especially the geared ETFs that we're talking about. It's going to pay off big time if you can consistently invest when the market is having those terrible periods, because you can have a 3, 5, 7, 8, 9 year period where the outperformance disappears because of the downturn. So if you're able to invest when the market is down, and because it's down in a magnified way because of the gearing in the ETF, you're going to end up with much better performance over the long run, and you're going to actually make the most of this type of product and actually get the most out of the gearing that you're investing with. So that's definitely worth considering. And obviously you're going to have somewhat of an iron stomach to be able to do that. And so it's not going to be suited to newbies. It's going to be, I'd say, people with 5 years investing experience who've either been able to sit through some previous downturns, and then you kind of know yourself enough to know that, okay, I can sit through periods like this and still be able to invest. And so then you know that you kind of invest going forward with greater confidence that you'll stick with your plan when times get tough.
Yeah, and I mean, just for people's benefit, to really make it pretty real too, it's like, if you look at, say, IVV, the US stock, that went down about 15% between the first of, the early March and early April. So if you put money in NAB, if you put $100,000 in a NAB Equity Builder to leverage up to 500,000, I can't remember what the LVR is, and you did that right on early March, by early April, you're going to be logging into your account and you're going to see that you're down like 70, 80 grand. And you only put in 100, and you only, it's like, so as Dave said, like when he mentioned that's iron stomach, that's like a real practical example of what you have to be mentally prepared to witness and hold the line, so to speak. That probably, this might be our longest podcast episode ever, Dave. One of our most interesting, I think, too. I hope that was useful for those listening. If you are interested in geared funds or NAB Equity Builder, margin loans, or anything like this. I know we didn't go into super technical detail, but hopefully you got the gist of the differences between these generally and where they may or may not be interesting for you. It is important to remember that these products are not for everyone. As we've just said, you do need pretty high conviction and making sure that you don't suddenly need the money one day. So there is a certain level of financial security that comes from getting leverage, basically. But see if it's right for you, and there's no harm sometimes in just putting a little skerrick of your money in something just to kind of see how it goes.
Yeah, well said, mate. So as always, guys, reach out if you've got any questions or topic requests. You can always do that on our socials for Strong Money or Perla, or you can reach out to us at hello@aussiefirepod.com. And we've got a big Q&A episode planned for the next one, so stay tuned for that. Until next time, happy investing, guys, and we'll catch you soon.
See you, everyone. We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to perla.com to browse our resources, calculators, and community insights. Perla is an authorized representative number 1281540 of Sandland Private Wealth Pty Ltd with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk, and past performance is not a reliable indicator of future investment returns.